Hello and welcome. My name is Karen Rainey. I'm a partner at Citadel and I'm responsible for our Women's Initiative. We've just enjoyed the most incredible evening with the women in our network, where we engaged in a conversation on the world, money and you. The purpose of the evening was really just to have a conversation, to understand the noise out there and to make sense of it all. Today with me I have Yolanda Nordia and Vanessa Hofmeyer, who are investment specialists, to really summarize the key elements of the evening. Welcome. Yolanda, can you summarize again for us the macroeconomic view?
Karen, yes. I think currently the world economy really is fragile. And going forward, we expect fairly mediocre growth from the developed world, with growth of around 5, perhaps 6% from the emerging world in the next year or two. Importantly, for the world economy to avoid another recession, we do need America to avoid a recession. Why we say that is because European growth is very weak at this stage, and we need America to balance out the weak European growth. The emerging markets are not a problem. The UK is very weak, and Japan is always a bit of a question mark. So we need America to balance out Europe. And currently the assessment shows, based on numerous indicators that we monitor on a weekly and monthly basis, that America should be able to avoid a recession. And that's fundamentally important.
It sounds like there is a lot of uncertainty out there. Should we not just be keeping our money in cash?
And cash always seems like the easiest option because it's the one that has the least risk. You can put your money in the bank and you earn some interest. But if you look at the facts, at the moment you can earn 5.5% in the bank, and after tax that's 3.8% return. That's way below inflation, so over time you will erode your capital after tax and after inflation. If you look over the last 10 years, in fact you've got 9% out of the bank, just investing on core. That's 3% of heavy inflation, so that's actually a real return, but again, once you take taxation into account, so you erode your capital over time. So investing in the bank is not always a good idea. You do need to look at alternative asset classes. They will entail that will be more risk, so that is an important factor to take into account, but over time that will also ensure that you will get a real return in your capital, which is what you want to achieve. So alternatives like property and equities and bonds need to be considered. They will give you a better return over time, but they are also riskier.
You mentioned property. Talk to us about property as an asset class and what are the risks?
Property is crucial in the portfolio, and there's also a difference between owning your own physical property like your home as opposed to also investing in listed properties. And in fact, listed properties over the last decade have been an excellent investment. They've given you excellent return, well ahead of bonds, well ahead of equities, and extremely well ahead of cash. And not only locally, you've also had that same situation offshore. At the moment, however, if you invested in the property market now, especially in the listed space, we would be a little bit concerned about that strategy because property assets are expensive. So we would avoid that strategy today. Physical property is a different situation. You do need to own some property, whether it's your home, etc. But again, assess the portfolio, see how highly you are exposed to the property market and not be overexposed, because you do have alternative asset classes, especially at the moment, that are more attractively priced.
Yolanda, you spoke about value investing as a cornerstone of our investment philosophy. Just help us understand what is value investing and why is it a sound strategy?
Karen, in essence, I think I can summarize it by saying value investing is all about buying quality assets at discounted prices. So in essence, on behalf of our clients, we're looking for assets that's worth 100 Rand, but where they're selling at 60 or 70 Rand, for example, for emotional reasons. The price is lower than the intrinsic value. I use the example of the Woolies shoes, where the shoes, for example, might be worth 200 Rand, but for whatever reason, they're currently selling at 150 Rand or 140 Rand. And you can expect Vanessa and I to be there at the Woolies stores the next morning in our sleeping bags.
I'll be joining you.
Yes, at the doors of Woolies, and we'll be buying those shoes the next morning. Why? Because we're buying good quality assets at discounted prices. We then patiently wait for the market price to eventually reflect the intrinsic value. That is the essence of value investing.
A last thought from each of you. Vanessa.
Emotions always come into investing, and that's in fact the one that you need to try and keep out of your decisions when you're trying to invest your money. Having a clean approach to investing and why the asset is attractive, why you're investing it, is very, very important. And while emotions are crucial to your own money. The best investments that are made, the best investment decisions that are made come when emotion is taken out of it and you just look at the facts of the underlying asset class and whether or not it makes sense.
And from you, Yolanda?
I want to add to what Vanessa was saying is taking emotions out of it, look fundamentally at asset classes and then follow a long-term approach. Because especially when you follow a value investment philosophy, you have to have patience. You have to wait for that market price to reflect eventually the intrinsic value. And that takes a long-term perspective and it demands patience.
And of course, having a sound financial plan.
Absolutely.
Absolutely.
Thank you for watching. Until next time, goodbye.